All right, so let's start with our speakers today and introducing them. This evening's speakers, we have Dennis Lockhart, and his career includes time in the private sector, academia, and government. He recently stepped down from the position of President and CEO of the Federal Reserve Bank of Atlanta. In addition, he served on the Federal Reserve's Chief Monetary Policy Body and the Federal Open Markets Committee. Within the Federal Reserve System, he chaired finance and merchant banking in Europe, Asia, Latin America. Dennis has held various positions, both international and domestic, within Citibank. He worked in Lebanon, Saudi Arabia, Greece, Iran, Latin America, and the Southeast United States. He was educated in Stanford and the Johns Hopkins University School of Advanced International Studies, and he attended the Senior Executive Program at MIT. And he's also served as an officer at U.S. Marine Corps. Please welcome Dennis Lockhart. We also have Rick Rieder, Managing Director, BlackRock's Chief Investment Officer of Global Fixed Income and co-head of BlackRock's Global Fixed Income Platform, a member of the BlackRock's Global Operating Committee, and chairman of the firm-wide BlackRock Investment Council. Before joining BlackRock, Mr. Rieder was the CEO of R3 Capital Partners, and he's also served as Vice Chairman and member of Borrowing Committee of the U.S. Treasury, and he's currently a member of the Federal Reserve Bank of New York Investment Advisory Committee on Financial Markets. Mr. Rieder also serves on Alphabet's Investment Advisory Committee and the UBS Research Advisory Committee. He was awarded the Global Unconstrained Fixed Income Manager of the Year for 2015, and he was inducted into the Fixed Income Analyst Society Fixed Income Hall of Fame in 2013. Earlier in his career, Mr. Rieder was with Lehman Brothers, most recently as a head of firm's global principal strategies team. He's earned a BBA from Emory, MBA from Wharton. He's a member of the board of Emory University, Emory Business School, and he's also the founder and chairman of the Business School's BBA Investment Fund and Community Financial Literacy Program. Please welcome Mr. Rieder. And to moderate this evening's discussion, we have our past president and current trustee, John Skinner. John Skinner became a charter holder in 2012, and he's been volunteering for the Asset Society since 2010 in a variety of roles, including the president, the VP of Programs, VP of Education, trustee, research challenge coordinator. He's been with us for a very, very long time. John moved to Atlanta in 2003 from Cincinnati, and he has a Bachelor of Arts in Music from Furman University. Thank you, John.
Thanks much, Arad. I believe I was probably asked to moderate tonight because I knew I wouldn't talk much. So I'll go ahead and get right to the content, guys. First of all, just kind of, if you could, and we'll start with Rick if you could, we'll just ask about the general state of the economy. Where are we in the current business cycle? How did we get here? And if you could just maybe a little bit about your current policy outlook.
Sure. So thank you all for having me. By the way, also thank you. Whenever somebody gets into the bio and they say the Fixed Income Hall of Fame, everybody laughs. So thank you very much. Nobody knows why there is a fixed income. You have friends ask me, in Canton, Ohio, so where do you visit you? And it's, anyway, so thank you all for not laughing at that. So a couple things. So where are we in the economy? So we have a very optimistic view on where we are growth-wise in the world today. We think there's a few things happening. I'm going to talk about one that's maybe a bit off the beaten path in terms of why we think the economy has some near-term. We'll have some continued persistent growth through 2018, which I'll talk about in a second. But one thing that I think is happening, obviously we talk a lot about the dynamic around what's happened to employment, with the Fed obviously being extremely accommodative and helping create what has been an extraordinary employment dynamic that we think will continue to promote consumption forward. I think people grossly underestimate as well the housing market's influence on growth and consumption in the world. We think We can talk a bunch about the new tax bill, et cetera, and the influences there. But we do think that consumption will continue at a very strong pace. We'll talk later. I have a very strong view about the influence on technology on the economy. And I actually think when you look at what's happening in terms of goods, the growth of goods year on year, consumption is about up roughly 4.0%. We think that continues somewhat because we think the pricing has come down significantly, which we'll talk about in a second. The other thing that I think is incredible about the economy is you're seeing something. Listen, I think the economy, I think we're going to talk later about demographics, follows a demographic curve very closely globally. But I think you're going to see a cyclical impulse. We're in the middle of a cyclical growth spurt that I think is significant. We are in a period today where 26 out of 27 countries, large countries in the world, are growing today. You never see that. You're having a dynamic today that China, which is now 38% of global growth, is also growing. We think high-frequency data is slowing a bit, but is growing. You're seeing a global growth phenomenon that is really powerful, that we think is persistent. I want to talk about one thing that's off the beaten path. We're going to talk about other drivers of growth around the world, but there's something that I think is really powerful that we think about a lot from the investment side. I think we've lived in this dynamic for the last few years that companies have thought about their business a bit differently than anything I've ever seen before. When you emerged from the crisis, companies were flush with cash. They had cut costs dramatically, so were throwing off huge amounts of free cash flow, and had de-levered their businesses. So you had a dynamic where interest rates were low for a long period of time, and as a company, you had what was a very tough decision to make as to whether you're going to spend on CapEx or you're just going to buy back your stock. If you buy back your stock, you create the same ROE benefit without having to worry about a 5-year throw on that investment. You get the same ROE benefit if you're incented that way. I presented this at one of the New York Fed committee meetings where I showed the risk reward of buying back your stock versus doing CapEx. And that I would argue that it tilted towards doing equity repurchase for a variety of reasons, particularly given where their balance sheets were at the time, i.e. not terribly levered. There's something very different today. And I think there is something, we could talk about the tax bill and the implications of the tax bill, but I do think you're in a very different position. And much of how I think that growth will be persistent, I do think CapEx, you're starting to see it accelerate, and I think that will be durable. And one of the reasons you think about how companies think about their businesses, and I spend my whole life talking about companies and looking at credit, I'm talking about companies today, but you have a very different decision set, i.e. your stock has rallied significantly, your cost of debt is going up, albeit marginally. You also may get, which we can talk about in this tax bill, a direct expense benefit, and your interest expense deduction may go away over a period of time. You've got this window today where you actually may get this incredible subsidy in terms of what the tax bill is going to give you, plus global growth is strong. Your incentive to do CapEx is durable, and we think it is significant. And I don't think people talk about that in terms of what really creates the multiplier effect through manufacturing, through energy, et cetera, is when you get the CapEx cycle moving. And we actually think today it is moving for a variety of reasons that's beyond just the, what is the normal, do I think growth in my business is going to grow? You actually have what is your balance sheet dynamic is different as well.
Thank you.
Same question?
Same question.
Well, I think Rick and I see eye to eye for the most part. I'm perhaps a little bit more cautious, even though I'm no longer with the Fed. I still speak like that. And I'm not in the fixed income Hall of Fame either. So.
You have no credentials for that.
The economy is performing well. The economy is in a good place. And I say the economy, I'm really talking about the U.S. economy, but the context is a quite positive global economic picture at the moment. The economy is continuing to generate jobs, so employment is at a point that is actually well below what most economists would define as full employment. The one interesting issue really is inflation, and I think it weighs on the minds of policymakers. And I think it will certainly be a factor in the discussion at the table next month at the FOMC. It may not deter the committee from raising rates. I, on balance, believe the committee will raise the policy rate by a quarter. But the discussion will be the behavior of the inflation data. So you have a little bit of a conundrum at work today in the U.S. economy, and that is growth appears to be solid, and if you believe the last 3 quarters, even better than solid. There's no recession really on the horizon, no obvious causes for a recession to be forecast in the intermediate term. And yet with all that, companies don't believe they have much pricing power and inflation remains soft. So it's a go figure kind of situation. And it may actually give rise, if it continues, if that sort of disconnect continues, to a really fundamental review by the economics profession and by the internal staff of the Federal Reserve as early as next year on the question of, do we understand inflation? Do we really understand how inflation works in a modern world? But when I step back, I think the economy's in a good place, and the risks around a baseline outlook of continuing moderate growth are the normal set of risks, and not anything that I think is weighing heavily on the prospects for the economy. So I will support much of what Rick had to say, which I thought was a quite optimistic outlook.
Fixed income people are not supposed to be optimistic.
That is
very rare by now.
You're not very effusive, you fixed income people.
I'll ask a fairly obvious question, I guess. The market and the media have had plenty of time to react to the appointment of Jerome Powell. I would just be curious to know if there's anything that you think we may have missed, if there's anything underneath the surface, or was the kind of consensus as a sort of status quo, if not maybe a little bit of deregulatory choice? Is that kind of accurate?
I really don't have a great deal to add that you haven't already read, except that I know Jay Powell he's I would consider him a pretty close friend, and we've spent a lot of time together over the last 2 years in my time at the Federal Reserve, and I worked with him for 5 years total. So he is not an economist. He's a lawyer by background and was a banker and then later a private equity player with Carlyle in the private sector. I think that's a good thing. At the same time, having observed him in FOMC meetings for 5 years, he's fully capable of discussing and talking about and communicating for the committee monetary policy. So I don't really see that is a deficit in some way. He's by nature a collegial, consensus-oriented, sort of a centrist. Now, you can make a distinction between being a policy centrist and being a consensus builder. There may be the time when the chair has to build a consensus around radical action. Ben Bernanke had to do that. But by nature, he tends to be a centrist, has been on policy. And I think what he represents is continuity of the basic direction of Fed policy, which is gradual increase in the policy rate and therefore the interest rate structure to what will still be a very low, by historical standards, very low structure of interest rates, and the continuing shrinking of the balance sheet, the unwinding of quantitative easing. The committee, I believe, hopes to do that as basically on autopilot with no effect on either mortgage-backed markets or markets in general, just a very slow, gradual process of unwinding that. I don't see, therefore, much change under Jay Powell unless conditions change.
So I defer to
You agree with me?
Yes, sir. You certainly,
I'm in the Robinson College of Business Hall of Fame.
So I'd say a couple of things, and I defer to Dennis, obviously, on seeing Jay Powell in action. I would say a couple of things in terms of market's reaction. First of all, there are like 4 more seats that have to be filled So the philosophy of the Fed surely could evolve to a great extent. I must say, the way we were thinking about it and the way we were managing risk, and we didn't think that there would be much of, in fact, you know Kevin Warsh very well. We didn't think that even under the markets. I saw an incredible stat that I think it was Barclays put out about the difference in what the dollar would be if it was Warsh versus Powell, and I think it was a 4-figure difference in DXY. I didn't believe that at all. I don't think Kevin was very, very different today in terms of his perspective on where the Fed is and what the Fed is initiating or has initiated and what plans to carry out. So I didn't think that was going to be different. I do think that John Taylor, I mean, there's a vice chair role that's still open, and unless you're going back, I don't know but there is a vice.
I'm seeing John Friday morning.
Got it. There is, the markets have a tough time reconciling the Taylor rule and how to think about where the funds rate would be relative to what he's said. In a Trump administration, or according to the Trump administration, that's the one that markets would have a tough time with. And that's part of why you start to see some of the rates market, the equity market, have some volatility around it. And I still think today that the markets would have a tough time adjusting to that one if he were vice chair, but it's very different as versus the perception of if he was the chair. And the market's perception of Jay Powell is very much one of consensus builder, one that's going to be pragmatic in his thought process and continue the plan that the Fed is undertaking. Is that fair?
There's an important point, and that is, it really is a committee process. And although the chair has significant influence on policy, and in a jump ball, the chair is likely to win or prevail, still, a chair has to bring the committee along. And I think Jay Powell will do a good job of that. I kind of agree that I don't think Kevin Warsh actually would have been different. Now, it's an interesting comment you make about John Taylor if he were appointed vice chair. I don't rule that out at all. Because there are a lot of seats, and he might be quite willing to serve as vice chair.
Thank you. I'll bring up kind of our first theme here, this technology. We've gotten to the point with technology where we as investors and policymakers may have to think about trends in productivity, trends in growth, trends in unemployment. We have to start looking at that differently. And how does that impact policy going forward?
You have strong feelings about technology, so let me talk first. That'll give you plenty to react to. I'm not going to take a position. I'm going to be somewhat neutral on what I think is the central question about technology, and that is whether emerging technologies that we see today, and I would include artificial intelligence, automation, robotics, autonomous vehicles, 3D printing, deep data, and so forth. Artificial intelligence probably being the centerpiece of all that. Whether that set of technologies is going to substantially change the trend line of productivity growth in the economy. We are in a secular trend that pre-existed the financial crisis and the recession of weak productivity growth. And a professor, a thinker named Robert Gordon at Northwestern University, written quite extensively on this. He is a techno-pessimist. Rick is probably a techno-optimist. The pessimist is he's not failing to acknowledge those technologies, just arguing that they are not going to be transformative of the economy in a way that is similar to the advent of electricity or the computer or maybe the internet. And that although they are important technologies, they aren't going to change everything the way electricity or the computer came close to doing. Another set of scholars, led by Nicholas Bloom at Stanford, two other Stanford economists, and one at MIT have a working paper out under the National Bureau of Economic Research. It's entitled, "Are Ideas Becoming Harder to Find?" And their analysis is that the inputs to research are growing, and they're on the ascent, and the product of research is declining, which is another way of saying it takes more and more inputs to create an outcome, a positive outcome for the economy out of R&D. And they point to a number of micro sectors, but one interesting one that everyone in the room will know about is Moore's Law. Moore's Law, basically the computing power will double every 2 years. The factors that go into that in 2017 are, according to these guys, 18 times greater than in 1970. So the economy is maturing and becoming harder to achieve gains from technology. Now, I'm going to remain agnostic on this, but I think it's important that these arguments be out there, because it's a central to debate about the growth potential of the economy, and that is whether or not productivity growth can improve.
So yeah, I mean, I've actually been on panels with Dr. Gordon, and who I think is a genius. You know, I have a different view. I mean, I think that we're going through what is a commercial change like nothing that we've seen before, and it's different in that. And it's, you know, it's a question I completely agree with Dennis around the concept of productivity and how do you think through that. But I think it's a cost revolution like nothing we've ever seen before. And I'll tell you about this in a couple of when I sit on Google's advisory board, and whenever I sat down with Eric Schmidt, and I said, I showed him all my charts and why we think inflation is accelerating, led by wages, and we think, so he looked at me and he said, we're not going to have any inflation anymore. He said all the marginal costs in the world, all the frictional costs are going to get taken out through technology. He made a comment. I'm going to go a different direction, and you know, he's biased as well. And I'll make a comment about, you know, he said, I thought we hit the Moore's Law curve in 2010, that we would start to flatten out. And he said I was wrong, and he said, I think that artificial intelligence is taking us to a completely different level. Listen, why I think there is something very, very profound that's happening is I think you're changing the way commerce works in so many different areas. And you know, you go on for hours and hear about different forms of commercial activity in the world. But the way we used to use brands, the way brands were marketed, you know, it used to be that you had a big brand and be sold through a local outlet. Now you're taking it's now the big distribution center that can sell small brands and create this different commercial enterprise today. We look at food, the cost of food, the cost of apparel, the cost of transportation, the cost of energy through horizontal fracking, and the productivity through horizontal fracking. You're changing so many different the ways that commerce works in the world today, and many of them literally doing what we used to do. And this is why I think it's ambiguous as to how the economy actually performs relative to this, because so many of this is doing what we used to do at a fraction of the cost, taking out the middleman, taking out the frictional costs in the system. But you look at the equity market this year, it's up, technology's up 38%, the S&P 500 is up 6%. And when you strip out technology, it's up, I think, 16%, but if you strip out technology, it is an extraordinary dynamic today. Well, and now I think we were talking about the last Google meeting, the next area is think about what's created, where you've had tangible inflation in services led to a large extent, to some extent, by education and healthcare. You know, we had a long discussion about healthcare disruption in things like biosimilars, things like generics, et cetera, things like the ability to analyze DNA and look at the human genome differently. And insurance companies now doing actuarial studies because they can map genetics effectively. I mean, I think this is an extraordinary, but I agree, it's ambiguous. You're replacing a lot of people as well through robotics and automation, and it's very unclear. The only thing I'm certain, it's like one thing about chief economist at Google said that I don't know how to reconcile. He said 100 years, if you go back 100 years ago, the average work week was about 100 hours, which is about my work week now, so I don't know that we've really developed. But he said now it's about 34 and a half hours. He said in 2050, the average will be about 15 hours, which is what I'm looking forward to. But he said it's going to be about 15, and he said, you think about how that economy will play out in terms of people and government assistance on the backside of it. it's almost hard to envision, it's hard to think through, but you could see how we're moving in that direction, which I agree, it's hard to think through what it means for productivity, et cetera.
And you make a good point that part of this debate is what's going to happen in terms of employment.
Okay.
There are a variety of views, from evolutionary, where jobs will change, but there'll be parts of jobs that are automated, not whole jobs necessarily, to those who believe that this will be disruptive, and soon, within the decade, we'll see people thrown out of work because their jobs will be automated. Again, I think it's important to understand the debate, not necessarily, in my case, be so presumptuous to have a definitive opinion on how it's going to play out.
I would like that, if you could elaborate a little bit more in terms of how that impacts policy. When you're looking at unemployment, how do you manage this when technology is improving to the point where maybe it does force some people out of jobs? Do you look at secular employment trends differently?
Well, let me point out that one of the two statutory objectives of the Federal Reserve is maximum employment. So imagine a world in which technology starts to really create lots of layoffs, and people become, certain cohorts become sort of unemployable. Well, at least under current law, the Federal Reserve would have to respond by being aggressive in terms of monetary policy, which has historically meant low interest rates. I think for a variety of reasons, we're in a low interest rate era. It's unlikely to change, low inflation being one reason. But that could add to this kind of, let's just say, challenge to keep people employed. Now, maybe there would be a change of law, maybe we become a single mandate central bank, not a dual mandate central bank, who knows? But at least under the current structure, if unemployment spiked up, you'd have to respond.
And maybe if you could elaborate maybe on how you would see a move to a 15-hour work week.
For me?
Right. Yeah. Well,
Yeah. No, so, listen, I think the world is changing so darn quickly. I mean, we talked earlier about, I do a lot of work in education, urban education around the country, including a lot of work in the city. Listen, if we don't improve the educational dynamic, we're moving more to a service-oriented economy, full stop, globally. Some economies are migrating faster to a service-oriented. Emerging markets are even moving more to, we're talking about how the technology epicenter in the world is actually maybe shifting from Silicon Valley to China. And, you're having, service economies. Think about how China's economy, you go from an agriculture to manufacturing. That is moving very much to a consumption-oriented, more service-oriented economy. If we don't have, in this country, the best education system, it's very, very difficult to compete globally. We're going to lose a lot of people. The number one job in this country, the number one occupation is driving. And I think it's 3.1 million people, I think, roughly, are affiliated with that industry. I'm a big believer in we are moving faster down the pike. That's probably a bad analogy. We're moving faster. I can tell you one funny story about this, but we're moving faster towards autonomous driving and than I think people give credit to, certainly in the trucking industry and in certain areas. But I think it is really, really difficult. The social aspects of this are challenging, but I am a devout believer that if we don't improve the education system in this country, it's a problem. And particularly in urban centers, it's a big problem.
Thank you. Kind of moving to another topic, I guess related to education, at least the demographic trends in the U.S. And if you could speak, I'll start with Dennis, definitely. How do you see demographic trends in the U.S. particularly impacting future growth, healthcare expenses, and retirement plans?
I believe we have an underappreciated demographic drag on potential growth and therefore actual growth in the economy. I think one simple way to think about that is the growth rate of the workforce. Gross domestic product has various definitions, but one definition is the growth of the workforce times the hours they work, times a factor that derives from the gear that you give them to do the work. So capital deepening, capital equipment. Before I left the Atlanta Fed, my staff ran some scenarios for labor force participation. And even though we have seen recently a slight uptick in labor force participation, they came up with no scenario in which the decline in labor force participation would not continue. The recent uptick is interesting, by the way. It's almost entirely unskilled women returning to the workforce. That's just in the last few months. But the bigger story and the real driving force is the retirement of baby boomers, which will continue, and that will continue to put pressure on the growth of the labor force. And I think that's a significant factor in how rapidly we should assume the economy's going to grow. I came to the conclusion as a non-economist that the economics profession doesn't or has not fully appreciated the influence of demographics. But I see growing recognition of the demographic influence on the economy. We have a living laboratory of the effect of demographic change on an economy. It's the country of Japan. And Japan is more of a pure situation than the United States. I'm not suggesting the United States is like Japan, but you can watch what's going on in Japan, and they of course had weak growth, on and off again deflation for 20 years. I'm not suggesting that's the fate of the United States, but I do think demographics are significant, and they have first and second order effects that are important. I'll give you one example. Day before yesterday in the Atlanta Journal-Constitution, there was an article about the topping up of the teachers' pension fund in the state of Georgia, taking, I think the number is $351 million to put it back where it's supposed to be deemed solvent. That's $351 million. It could be spent on education, could be spent on infrastructure, but the first order of spending is to top up pension. And we're going to have, for quite some time, pension and health care requirements and elder care requirements that are significant in our society because of the demographic distribution.
I agree with everything Dennis said. I would say, a couple of additional points I would make, and we study this aggressively around, we've shown this in these monthly calls, how economies follow the demographic curve incredibly closely. You can have spurts off of that curve over the short term, but it follows very, very closely. But I want to pivot off something that Dennis said around Japan and Europe that have more pernicious aging demographics than the U.S. does today. It has huge ramifications for the investment paradigm in a couple of different ways. One, the demand for income is like nothing we've ever seen before and will continue. And we show this chart that shows that the amount of money that has to be put back into the system, largely pension, as Dennis said, an insurance company, is 4 times bigger than it was in 2000. And you create this dynamic that it's, when people say rates are going to move much higher, you have 2 countervailing factors that work against you. One is the potential growth in the world is lower, and 2, the demand for income is pervasive. That you create this dynamic that it's so hard for interest rates to move higher. And then I'll throw out one other point to this, as someone knows better than I. The Bank of Japan and the ECB are in this unbelievably difficult position in that A, they have a more pernicious aging demographic, and they have too much leverage on those systems, which is very hard to come out from under, so you have to keep policy rates lower for longer. And I know I've said this a bunch of times on the media and otherwise, that we watch it in our platform, that the dynamic of when the Bank of Japan keeps rates at 0, and when the ECB made the comment a week and a half ago, I think it was a week and a half ago, where Mario Draghi said, we're going to keep rates lower well beyond the time we end the quantitative easing program. That changes the framework of the 10-year Treasury much, much bigger than people think. Every day, the first thing I do every day, and I'm responsible for $1.7 trillion of fixed income assets, we gotta watch this thing every day. The first thing I ask is how much did Japan buy last night? And then I look at our proposals, or our request for proposals for mandates. And when I think the high yield market, which was soft today, when I think high yield is gonna come under pressure, or I think, markets, investment grade credit come under pressure, then I look at all the demand that's coming right from Japan for those assets. It is an extraordinary dynamic that our 10-year treasury, where I would argue the term structure of interest rates in this country is too flat. I mean, the 10-year should be significantly higher than it is today. It can't move because the demand that comes in, because of the demographic, and because you have demographic married to leverage, so they can't let policy rates move higher for an extended period of time. So what does it mean for all investments, not just rate investments? By the way, part of why I think equities keep going higher is because that discount rate on equities is going to stay low for a long time. And we can talk about also the interest expense that companies are because of the cost. Anyway, by the way, I'll give you one stat. So for Halloween, I had to do for Bloomberg TV. They say, what's the scariest chart you have? And there are a lot of things that I thought about. Anyway, the one that I showed, which is an amazing statistic, the average 3 to 5 year borrowing rate for European corporates is 0.30%. These are corporations borrowing at 0.30. The 2-year treasury is 170. By the way, that was reversed. That relationship was 400 basis points reversed if you go back a couple to 3 years ago. There's a lot of reasons why it's hard to, European corporates are there relative to bunds. They're actually not terrible relative to the bunds, where bunds are. That is nuts. You're financing companies at 0.30%. What happens is the whole benefit, because the cash flow gets down to the equity. So that's why the equity market continued to stay higher. But the ramifications are extraordinary in the world today, largely driven because of that, because of what I think is this extraordinary demographic.
Speaking of the worst chart, the scariest chart that you have, we're going to ask about tail risks.
Yeah.
And what particular tail risks do you think may be undervalued by the market today? How do you manage them? How do you look for them? And how do you monitor them?
So there are, it's interesting watching. I mean, we manage a lot of assets, and I just assume a few less little rocket man comments come out when I look at Twitter all the time. Listen, the tail risk in North Korea is hard to figure out. It's hard to analyze. It's hard to hedge. You can't hedge it. We try to think about in our business, how do we think about a major event around that? Anyway, that's hard, but I don't know what you do with that, other than we run a bit lower risk than we would otherwise because of that. But that one was hard. China is still, I think as we were talking about earlier, I think China's going to continue to do well. It is also too levered, and it is also potentially, if you think about what happened last year, capital flight is a problem. And if you create a capital flight dynamic, the Nikkei was down, 22% in a couple of months. The DAX was down 13, and our markets are down. China's 38% of global growth, and you figure that they're growing faster than the rest of the world. China's a bigger risk. I think it's going to be fine. The one that actually keeps me up at night that I would never say in the media is the fact that financial conditions are easy, which I think the Fed has certainly addressed, and Dennis can talk about much better than I can. Anyway, where you're financing, where we're financing, you're seeing this in underwriting standards that are deteriorating. We see it in auto finance. By the way, in the loan market, in the CLO market, you can't believe how many deals we miss because somebody says, I don't need any covenants, I don't need any structure if I can get 5 basis points. That's not going to blow up in 2018. That is going to blow up in 2019, 20, whenever the next recession is. We're financing, not we, but the markets are financing credit card debt at spreads of 15 off. Doesn't make any sense. These financial conditions are too easy today in the financing market. There's not too much leverage in the system today, but I worry about this function we were talking about earlier. Everybody's selling volatility. You can sell it in a bunch of different forms, but it's really dangerous when you sell it in forms that you can create some catalyst to disrupt that. And that's the thing that I'm worried about, because markets are big. And if you get some catalyst, because of the amount of volatility that's been sold, because of the amount of structure that's been taken out of the system, and where asset valuations are, it's a dangerous paradigm, which again, I don't think is going to be a problem for the next few months, but it's something that we really have to keep an eye on.
Let me just sort of roll the film back here a little bit. It's important to remember what a tail risk is. It's a very low probability event that, if it happens, is extremely damaging. We had a tail risk event in 2008. So the predictability of such a thing is really quite low, I think. My own view is, and Rick cited some of the risks out there, that if we have a tail event or a tail period, it's likely to be the confluence of 3 or 4 things that individually might not be so damaging, but when they come together at the same time, they create real damage to the economy. A correction in the financial markets, depending on how great, but a correction is not necessarily a tail risk event, just a correction, and then markets continue to move on from there. If I were to look around the world and say, what is it that could be part of a confluence of events, I would cite Chinese debt. And interestingly, one of their officials at the party Congress gave a speech talking about the concept of a Minsky moment. Hyman Minsky was an economist who basically believed that capitalism tends to build it in risk to an event called a Minsky moment, in which there is a really fundamental correction or fundamental adjustment. And that term was used by a Chinese official, which I found quite interesting, in reference to the debt leverage within their system. Geopolitical events of all kinds. Recessions will tend to be caused by a big change in consumer behavior, in this country at least. And that is most influenced by employment prospects. So the basic equation is if people feel comfortable with their employment prospects, therefore their income prospects, they will spend. And they will stop doing that when they get worried about whether they're going to be employed next week. So you'd have to think in terms of something that would radically change the outlook of the consumer in the United States, and that would probably be related to employment. So those, I don't think you can pin this down. I would distinguish between a tail event and simply a shock. And shocks occur all the time. Historically, recessions have been associated with rapid rises in oil prices. It doesn't look to me to be in the cards. Unless Saudi Arabia, which could happen now, has a real internal crisis of some kind that shuts things down. But with fracking technology, I don't see oil prices rising to above $100 a barrel, so I don't see that as much of a risk. But you can be sure that there are risks out there, and we'll probably be surprised when they come together to create some kind of a major event.
Yeah, I'd ask you to also elaborate maybe on how policymakers would assess and kind of incorporate these kinds of events into their analysis.
Well, the big lesson of the financial crisis, 2008 and 2009, is that tail risks do happen. So the consciousness of the reality that we're constantly living in a world where a very low probability event can happen is now burned into the consciousness of policymakers. But the classic approach is to have a baseline outlook, and I think the baseline outlook is what we talked about largely at the beginning, which is pretty optimistic, and not effusively optimistic, but moderate growth and continuation of the current expansion. And then build upside and downside risks around that basic outlook. And that takes into consideration a variety of things. I'll give you an example. I was still in the Federal Reserve, and of course at the December meeting at the end of 2016, where we did our projections, our 3-year projections for the economy. And because it came right after the election, I would say about half of the committee built in fiscal stimulus into their outlook. And another half basically held back from that assumption. By March meeting, the outlook was largely the same, but very few of my former colleagues had built in fiscal stimulus. And now I think fiscal stimulus may happen or may not happen, but nobody's assuming it's going to happen. But that's sort of the way you have a baseline, and then you build a both positive and negative, upside and downside risk scenario around that baseline.
Thank you.
Well, that's enough of my questions. I think we'll open it up now. So just raise your hand and I'll give you a call.
So I want to talk about yield curve and potential for inversion. So Rick, you mentioned about it's hard for the 10-year to rise from here. Yet what's the 2 to 10 spread? Is it 7-ish? So that's 3-ish corporate rate. How you wrapping your mind around potential for inversion?
So it's a really tricky thing, and I have to say, our view of going back literally has evolved the last couple of weeks. And I'll tell you why it's evolved. For the first time in a while, we actually think the front end of the yield curve is actually pretty attractive to actually buy carry on. So we are trying to talk about this a lot. We're trying, now you're pricing in. You're not pricing in fully if the Fed is roughly going to move in December. Let's say it's 3 times next year, roughly. 2 year, 3 years, not that far off. We're still for some probability of growth slowdown. So we actually think the front end of the curve. We like to buy a lot of securitized assets, commercial mortgages, non-agency, CLOs, treasuries and we think the front end, by the way, munis are not bad off the front end, although ratios are better in the back end. Anyway, the front end for the first time, where we've avoided the front end, we've been short the front end for a while. We actually think it's very investable. We think we're seeing a lot of money flow into front end of the curve. By the way, corporate cash, which is the new investment dynamic that you haven't had historically, a bunch is moving a bit out the curve, but sitting in the front of the curve. The tricky thing, the reason why my opinion evolved, is we actually think going out to the back end and taking that duration risk to go out to the back end didn't make a lot of sense. But I have to say this, the ECB dynamic of well beyond has now made the curve tricky, in that you can't, the back end of the curve we thought would steepen out a bit, and now I think it's really tough. And now I think it's going to be, with German bonds at 31 basis points today, and JGBs at 5, it's pretty hard for U.S. Treasuries. So we think what happens, so we're pretty neutral, which I love on TV when you say you're neutral, we say, okay, next. But we're pretty neutral on the curve right now. The risk of inversion, which I really didn't think, but now you're seeing it. There was a buyer, and I don't know if y'all, and I'm closely y'all follow, not to get too technical, but the long bond this week moved, in the last 4 or 5 days, moved 3.5 points. There was a buyer, big buyer coming out of Asia, and it's pretty extraordinary how the long bond goes to a 277. Why you would take that sort of duration risk throughout the curve when you don't really need to. But there is the risk that we invert, and that is a tricky dynamic for the economy. It's a tricky dynamic in a bunch of different how you think about returns and where you take risk. I will still say today, we don't think the curve is going to invert. We do think inflation is moving up. We think wages. We follow the Atlanta Fed wage tracker closely. We follow corporate earnings. You read corporate earnings reports. I mean, it is persistent. Can't find labor, qualified labor. So we do think you're getting a bit more inflation that keeps the curve and keeps the back end higher. But it's going to be an interesting few months to watch that.
I don't have a lot to add. The Federal Reserve can substantially control short-term rates, and the market dictates the longer end of the curve. So you just heard from somebody who lives in that market. I'm not going to argue with you. Okay.
I hope I get this question right, because I've kind of been noodling it around while you've been talking, so I hope I get it right. So I've been in business long enough to have seen portfolio insurance, long-term capital, which really sticks in my craw, but we can talk about that later. Obviously, the Lehman Brothers issue. So, two parts. The first is that, do we have any fiscal or monetary policy left to address any of these tail risk events that may come? And that would be globally, because obviously, small German banks owning junk mortgage securities had an impact on what the Federal Reserve did. I mean, it was a global response. So are there any tools left? And number two would be, given the populist movements, is there any political will to bail us out?
Well, you're touching on a really important subject. I think for a variety of reasons, the overall interest rate environment is going to be low by historical standards for quite some time. That means the neutral policy rate is lower than it's been historically. And over the last 2 to 3 years that I was in the Federal Reserve, and I was part of these projections, I saw the progressive decline in the prediction of what the neutral rate would be, which is another way of saying where the Fed would stop in a period of rising interest rates. And as recently as 2014, most of us were saying that's 4% for the Fed funds rate. Now, most of the committee members are at 3% or lower. So that means if we're in a rising rate environment, it would come to a halt, in theory at least, at 2 3/4% Fed funds rate. That also means we don't have, the Fed does not have a great deal of room to drop rates in response to a recession. Historically, the FOMC has dropped the policy rate by about 500 basis points to respond to a serious recession. So you can imagine a world in which you only have a couple hundred basis points that you can drop the rate to try to stimulate the economy. And one of the things that I observed in my early years at the Fed in 2008, 9, 10 is when people are afraid of borrowing, the strength of monetary policy is not all that effective. It's just, when it operates through the credit channel, when there's no demand for credit, it doesn't necessarily have as much stimulative effect as you would like. It took a long time for us to get to this position. And as you point out in your question, on the fiscal side, at least in this country, the federal government is constrained, although recently there certainly seems to be more changing of opinion about that. But realistically constrained in how much you can spend in a counter-cyclical type of fiscal policy. And state and local governments whose revenues decline typically operate under balanced budgets. So there's not a great fiscal stabilizer at work either. So I think your question reflects a serious concern. And what you'll hear from my colleagues, my former colleagues, is yes, we have tools. Policy rate tool, quantitative easing. In my opinion, the long-term effects of quantitative easing are not known. And one of the reasons policymakers are just want to unwind and also we've been nervous about what the long-term effects of QE might be. It's just unknown territory. Nobody's been there before. So I think the responses are limited.
I thought I've worked at Lehman for a long time, and I don't think I ran credit. I'd say there's an asset liability. There was a leverage problem in the system. It was an asset liability. The way you managed, the world was including Lehman, using short-term financing to fund long-term assets. And that was a problem. I presented to the Fed board back in 2007 on the leverage in the system. I don't know if you remember CIVs or reinsurers were running 45 times leverage. The French banks were running, I think the number was unlimited leverage against AAA assets. That leverage doesn't exist today. I mean, the leverage is not a problem today. The hard thing about regulating and how you think about it, everybody in the system has an IRR target or ROE target. And when you regulate what yesterday's issue was, the issue today is not gearing. The issue is the system is not geared like it was then. Households aren't leveraged, the financial system really isn't leveraged. Companies aren't that leveraged today. Government's got more leverage on it globally. That is, but you know, it's much easier to handle in the government sector. The thing that I think Dennis mentioned that is a tricky thing is when volatility stays down for a long period of time. Everybody's got a return target or a liability matching target. To hit your target, what you do is you keep stretching. If you run a traditional, not to get too technical, if you run a VAR model, you're running a hedge fund, you run a VAR model today, or you run a traditional, what is the risk you have to take? You literally have to take 3.5 to 4 times more risk today to hit your return targets than you did in a normalized condition. That's really hard to think through how does that play out. It's what I talked about earlier. The markets are selling vol, sell vol, sell vol. That's tough to regulate and that's tough to manage. Anyway, you know, hopefully, it's part of why I think the Fed is absolutely brilliant today about how do you think about financial conditions. You gotta normalize financial conditions because you know the tremendous benefits of quantitative easing and policy this low. But then the markets tend to find places where risk gets taken, and I think it's tricky. I think it's a really, really tricky dynamic. And I think there are fiscal ways to handle things, but I think it's hard as well. Somebody's not working.
Gentleman in the back.
Just dovetailing on the last question about tools, Mark and Goodfield at CMU had proposed exchanging savings, like an exchange rate from savings to spendable cash. It essentially be like a tax on savings. Like you have exchange rate and currency, but anytime you want to convert savings into cash. Have you seen this proposal and you think it'd be a useful tool? Would it be something that to think about?
I was hoping you were going to take that one. Yeah, I don't know why this is dead. I don't know. Do you know what? I don't know. Can you explain that one more time?
So you have savings, and then to convert it into spendable cash, you would get an exchange rate.
Yeah.
And so you would basically, you've got $100 worth of savings to spend it, you get $90.
Yeah.
So there'd be a conversion. And it would be a tool that they could set this exchange rate at. It is, in essence, it's a tax maneuver. It's a way of basically being able to convert short-term savings. So it's like using exchange rate instead of going negative, or like short-term debt rate. It's a way of basically going negative on the exchange rate.
I don't have much to say specifically on the question. But if we go back to the question of tools, one of the interesting possibilities of negative interest rates, which have been the policy in Europe and Japan. And in my experience, and I when I was still at the Fed, I got the question frequently, and I tried to discourage any serious discussion that we would have a negative interest rate environment in the United States. And I believe my colleagues would view it as an absolute last resort. But the zero lower bound, as economists call it, is no longer the zero lower bound, or at least no longer the lower bound part of that. And this is another monetary policy tool that where you have to wonder what's the long-term consequences, the institutional damage that's done to the insurance industry, to banks, of a period in which the short end of the yield curve is negative. And so that's, and again, I was triggered to think about that by your discussion of an exchange kind of rate. So Otherwise, I'm not sure I understood the question, so I decided to pivot and to talk about something else.
Do either of you guys have any comments about the Bitcoin phenomenon and whether that could be a bubble that might end in the not too distant future? And if so, what the ripple effects would that come from?
I'll make 2 or 3 quick comments. I think blockchain is for real. And that's the technology on which Bitcoin is built. I think Bitcoin and other cryptocurrencies may very well have a role with some continuing growth as a payment mechanism. But for the life of me, I have no idea how you can think of a $6,000 Bitcoin, which was 2 years ago $250, as an investment vehicle. It strikes me as just pure speculation with nothing other than the supply and demand for a slowly expanding supply as being the value. But I don't understand. I'm with Jamie Dimon in being skeptical on Bitcoin as an investment vehicle. Having said that, there's some interesting developments. China basically put the kibosh on Bitcoin, but at the same time, I think announced a project to create a sovereign fiat digital currency for payment purposes that, as I understood it, was to run parallel with the renminbi, but not be the renminbi per se. So when a sovereign issues a Bitcoin equivalent, that's a different phenomenon, quite frankly, and I think what it tells you is the digitization of currency as a means of payment is going to continue to evolve. And some countries may simply want their financial system digitized. Others may say, well, I'd like to have a parallel currency, which may be valued differently relative to the traditional fiat currency. So this is a very interesting world we live in this respect. I don't think Bitcoin is going to replace the US dollar as a reserve currency for the world in my lifetime. After that, I don't care.
So we spent an unbelievable amount of time on this in the last few weeks. And a friend of mine has been, I think, considered one of the, we went out to dinner and talked about it last week, who's, I think, considered the most provocative around Bitcoin. There is an argument, I've argued a bunch of times why gold has any value, because you can go through the periodic table. There's a lot of things that are scarce. Gold has hundreds of years of value as a storehouse of value, as a currency. But arguably, Bitcoin is a more effective than it, because you can actually use it more effectively for trade, and you can track every transaction. And by the way, I'm completely ignorant, but I'm learning. I'm spending 1 million hours on this, on the actual energy required to create them and the energy required to perpetuate more of them, that you can see why it can have a storehouse of value. I can't get my arms around the illicit behavior that goes on it and how to think through that. And but I am convinced that it is going to be, absolutely, we are public about it. We think blockchain is durable, and there are a number of reasons why it makes sense. I do think there'll be a Bitcoin, maybe Ethereum. I think there'll be a couple of them that are going to live on, and that, what the price is. I always get in this argument with my boss about what is the value of gold, and no, there is no answer what the value of gold is. And I think it's the same here, but my sense is that Bitcoin is permanent, and my sense is it is going to be part of a storehouse of value, and is it worth $7,200? It is, nobody really knows. My sense is it's going higher first, for a variety of reasons. The players are getting involved with it, but boy, it is it's hard to put a number on it, but it's going to get more and more attention. The industry that's built around it now, that continues to grow. We were spending some time about how do you actually trade it and warehouse it and the keys, etc. it's a tricky thing, but there's big business getting built around it. My sense is it's durable. But is it ultimately going to be a problem? You know, potentially.
Steve?
My question kind of goes back to this original idea of the central banks and volatility. It feels like the whole market has become one of a cooperative exchange where everyone's working together. And I thought each of the central banks were really focused on their economies, but they all seem to be working in concert instead of working on their individual countries. And I guess my question is, we've seen since the China decline in the beginning of 16, that the central banks have all agreed that they're going to communicate more, and I'm just not sure how that suppression of volatility is necessarily, as you're saying, people will now have to reach further for risk. I understand, you know, occasionally, but don't you think that in the last 5 years, every time the market has shown any volatility, the central bankers going in front of the press to console them and make them comfortable is creating more of a situation where their two goals have left the table in terms of what they focus their energy on?
Well, I think the low volatility is a byproduct of a monetary policy alignment of the world's major economies. That did not exist a few years ago when the Fed was basically, at the time, argued tightening, or at least coming off of zero, and nobody else was. What's happened is the European economy has picked up a bit. Even Japan has had some quarters of growth. The scare we had around Chinese decline in growth seems to have passed, and I don't know how precise the Chinese authorities can be about their growth rate. It seems to always come in at 6.8%, but China is growing. And so what has happened is the other parts of the world that were weak when the United States was continuing to recover have sort of come into line, and it appears like you have a highly coordinated monetary policy. Let me disabuse you of the idea that central banks coordinate policy. They do not, except in very rare circumstances. During the financial crisis, interest rate policy was coordinated twice by 5 central banks that all dropped their policy rate on the same day. But that is highly, highly extraordinary. Central bankers communicate, but they don't really coordinate. And every central bank, by law, is looking after its own national economic affairs. So what you have now is that it appears the central bankers are in concert, working in concert or in lockstep, but that is just because the economies of the world have allowed that to happen.
One thing I would add, I mean, I think the markets generally view the central banks as operating independently, and I think that is, there was an interesting question around last year, around February, around when China, when the issues were significant, and I don't know, my sense it wasn't coordinated. You guys know way better than I, but that clearly was an issue, and I think the fact central banks were addressing that issue, listen, I think was important at the time. One thing I would say is I do believe in this elasticity of interest rates, and I think that's something that's really, really important. And I don't know if Dennis agrees with this, but I think negative interest rates, when you press it too far for too long, that it actually goes the other way, and the dynamic goes the other way. And I think Japan, you saw that when you go to negative interest rates and you come off it. And I think, as I was pointed, you create a dynamic around net interest margin in the banking system that you quash volatility, you quash velocity in the system, and you hurt the savings dynamic. Part of why I think moving from 0 to 2 in the U.S. is not going to have any negative impact on the economy. But once you start moving above it, because of the way financial transmission works in the system, I think there's an elasticity of interest rates that's very, very different. And for one man's opinion, I think the ECB can move a bit more than they're doing today, and I think you can create ill effects from that. And I don't know whether it's a coordinated necessarily, but I think you have to. I think the policy works. I think the Fed's done a great job with it. And then I think you got to move off of it because you can create a negative effects from it. I think the ECB's been a bit slow, in my opinion, but Mr. Draghi's also a brilliant man, so.
Last one. No, okay.
Can you talk a little bit, so we've gone through several rate hikes now with the Fed, and we've kind of seen how the yield curves react to that. You know, they're going to start winding down asset repurchases. How do you see that impacting the yield curve, if at all, and how significant is that?
Can you repeat the question?
We'll repeat the question. Why don't I just let you repeat the question?
Question was, we've seen several rate hikes now and how the yield curves kind of reacted to that. I was wanting to see how much of an impact we expect asset repurchase wind downs at the Fed to have an impact on the yield curve, if at all.
Well, I can speak from the perspective of what I think today is the desire of the FOMC. And that is that rates gradually rise to a neutral rate that is lower, but gradually rise, and that is absorbed by markets and absorbed by the real economy, which is really the focus of Fed policy, without significant damage. In other words, why would you raise interest rates if you really felt it was going to have some damaging effect on the economy? The economy can handle that higher level of more normal interest rates. And very importantly, the balance sheet policy, which some of you may not follow it all that closely, is the cessation of reinvestment. You stated it correctly. It's not the sale of assets. It's just letting bonds mature, and as they mature, the proceeds are returned to the Fed, and the Fed effectively destroys the money. It's the opposite of what happened during quantitative easing. They ardently desire that that be a non-event on markets. And if it turns out to be an event, very easy to pause it, figure out what's going on. Or if financial conditions get quite different around the policy, very easy to slow it down or put it on pause. Because they really want this balance sheet normalization to go smoothly, be a background kind of policy measure, and really not have any discernible effect on the market.
I'll throw it just a little bit earlier, but I threw out a couple of interesting things. By the way, we calculate next year the delta, because the Fed's reducing at the same time the Treasury's going to be borrowing significantly more. The delta between this year and next year, we think is about $1 trillion in terms of what that delta is. So decent sized number. That being said, the liquidity in the world is much bigger. It's much, much bigger than that. So we don't think it'll have that much of an effect. There's something, though, that's very real. We did on this last monthly call. We showed about liquidity in the world. So if you go back 2-3 years ago, the central banks functionally plugged a hole in terms of liquidity, and a lot to do with hot money in China, and there was a liquidity hole in the world. That's changing. The world is now flush with liquidity because of global growth and reserve build. What's happening is the central banks, that liquidity the central banks provided, there's a question the gentleman said before, asked before, that liquidity is actually going into the system. The system is now providing liquidity. That definitionally is more volatile. And that creates a dynamic because it ebbs and flows with the economy. So what does that mean for the curves, and what does that mean? We think, like I said, my view changed a little bit with how long the ECB stays at the trough around rate policy. You know, we think that inflation is picking up. We think there's enough liquidity in the world. Supply is increasing, certainly in the US. So we think the curves can normalize a bit more, but it's probably going to take a bit of time for that to happen. And, by the way, we think inflation, when you study the data, you know, everybody focuses on, because the world loves a simple, what came out of Twitter. And the average hourly earnings report came out of payroll the other day, and it suggested, well, we're not getting wage acceleration. We do think we're getting wage acceleration in the economy. We see tangible. It's bifurcated by industry, tangibly. But we do think in aggregate you're seeing wage inflation that would suggest that break-evens can expand a bit. You get a bit more inflation in the system.